As we take a look at the discussion here and the points we want to focus on, obviously there's a lot of return data we're going to look at, but we also want to address some fundamental questions that you may be thinking about, but also questions we get from our clients on a regular basis, especially as we think about managing globally diversified portfolios. So we're going to keep this conversational between Mike and myself, and Mike's going to hit on a lot of data, but then I'm going to tie in what you can maybe some actionable items you can be doing with your portfolio, but then also we'll wrap it up with focusing on things you can control, because there's a lot of information that we're going to discuss and outlook here in 2025 that is uncontrollable from the market standpoint, but what action can you take to make better outcomes for yourself? So Mike, I'll turn it over to you.
Yeah. And as we go through the outlook for 2025 and beyond, the three specific questions we're going to be looking to answer. These are very fundamental common sense questions. One, why should I own anything besides the S&P 500? Very logical question. If you look at trailing returns across asset markets, in the rear view, that's all you've needed. The S&P 500 has outperformed pretty much every asset class by a margin of at least 5% annualized over 10 plus year time horizon. So as you look through the rear view, the path was clear. As we look through the windshield, the path is highly uncertain. So why should I own anything besides the S&P 500? Then bonds in particular don't look great if you're looking through the rear view. So when am I going to make money in bonds? And then, of course, we'll talk about the impact of the Trump 2.0 policy agenda as well. So we'll kick off with that first question.
Yeah, let's do it.
And what we're looking at here, and we'll throw this slide up on the big screen real quick. What we're looking at here, these are various areas of the stock market, and this is their distance from their long-term trend. So what tends to happen is if you have one area of the stock market that does exceptionally well for a very long time, it becomes extremely expensive. It goes above trend. It becomes a victim of its own success. And the poster child for that right now is this light blue line, the NASDAQ 100. You see right now it's 80% above its long-term trend. And that's because it's performed so well here recently.
Right.
But that is now almost as high as it was above trend at the end of 2021. And we know what happened in 2022. The NASDAQ 100 was down about 40%. So that's a bit concerning. And we're at the third most expensive levels in history. The only other time it was more expensive was the height of the tech bubble in the late 90s, early 2000s. So the NASDAQ 100 is now, the stocks that make up that index are also now dominating the S&P 500. So you can see the S&P 500 is 44% above its trend. So the simple reason why should I own anything outside of the S&P 500 is because the S&P 500 is extremely expensive right now. It has performed exceptionally, and now the companies in that index are exceptionally expensive compared to the alternatives. The good news is if you look at this same chart, these other areas of the market, US small caps, foreign stocks, they're actually below their long-term trend, implying they have room to catch up over the next 3, 5, 10 years. So if you're a long-term investor and you're looking at your portfolio, you always want to be thinking, hey, I want to sell the things that look expensive. I want to be adding to the things that look cheap. And that's how I'm going to reach my financial goals. So that's where we're at today. The S&P 500, extremely expensive.
Yeah. Yeah. And, thinking about, some like actionable items there specific to, some of these trends, just having awareness. And that's going to be a common theme throughout this conversation. As we think about, your portfolio, where have you been invested historically? A lot of these trends have been great, but if you set it and forget it, you could be adding more risk to your portfolio or have more risk exposure to your portfolio than you really wanted to. So as we go through some of the other slides, we'll add other actionable items there as well.
Yep. And awareness is another great point. So we'll throw this chart up on the big screen as well. When you own an S&P 500 index fund right now, you have to be aware that about 30% of every dollar you put in, 30 cents of every dollar, is going towards just 7 companies. So it's extremely top heavy. So the S&P 500 right now is, in that sense, the least diversified it's ever been. if we look at market concentration, so this blue line shows the percent of the US equity market that's made up by just the 10 largest holdings, you can see it's at an all-time high. 32% of the entire US equity market is just 10 stocks. So you have to be aware you're not very diversified if you're owning that S&P 500 index right now. And then turning this into the outlook going forward, we look at this data historically. Anytime we're at these types of concentration levels in the past, you think about the Nifty 50 bubble back here in the 60s, for example, what happens over the next 3, 5, 10 years is smaller cap stocks or the rest of the market tend to outperform those largest stocks by anywhere from 4.7 to 3.6% annualized over the next 3, 5, 10 years. So if you're thinking about how can I get that extra source of return going forward, well, it'll be by diversifying to areas outside of the S&P 500 that are cheap.
Yeah, let's keep going.
So staying with this point, why own anything besides the S&P 500? We're going to broaden that out and talk about, why own anything outside of the United States? Because yes, the S&P 500 has been exceptional, but any financial asset, any investment denominated in US dollars has also been exceptional. And the US is truly an exceptional place. We have an exceptional economy. We have exceptional companies. But once again, you pay exceptional prices for that. So you have to take that into account when you're thinking about your portfolio. So what we're looking at here, when we have these blue shaded areas, it shows the US is outperforming the rest of the world. And the red shaded areas, the rest of the world is outperforming the US. And it's hard to remember because it's been so long. I mean, the US has dominated financial markets for so long. But there was a time period back here in the mid-2000s when foreign stocks outperformed US stocks by over 10% annualized for 6 straight years. The narrative that's present right now, this US exceptionalism, it was totally the opposite back then. So these things happen in fits and starts. And you also look at when this period of the rest of the world outperforming happened. It happened right after the tech bubble burst. Leading up to the tech bubble in early 2000s, the US was exceptional, right? We had all the best companies, but once again, you paid exceptional prices for those stocks. And when those prices get a little bit too far ahead of fundamentals, investors are looking for an excuse to sell high, and they're looking for an excuse to invest in other areas of the market, whether you're an institutional investor or retail investor, and they'll flow into foreign equities. So our view is, one, areas outside of the S&P 500, outside of mega caps, look very attractive now within our investment framework. We're actively looking to diversify clients outside of those 10 largest stocks. And there will be a time this year, it's a bit cloudy right now because of all the uncertainty around tariffs, which we'll talk about later, but there will be a time where the rest of the world looks extremely cheap. Foreign stocks already look cheap in local markets, and foreign currencies look very cheap relative to the US dollar. So that'll be an opportunity this year and beyond as well.
Right. So to dig into that a little bit, so we've seen a strong dollar,
Yep.
Not just recently, but over the last few years. And ultimately, that's a negative return for international investments. Mm-hmm. So what you're saying too is if we end up seeing a weakening dollar and even muted returns internationally from a direct international standpoint, we can see nice positive returns because of that reducing dollar drag on international returns.
That's exactly right. If you think back to this summer, we had 2 bad labor market reports, and the U.S. didn't look very exceptional at that point. And in the month of August, foreign currencies outperformed the US dollar by over 3%. And the S&P 500 was flat, but a basket of foreign stocks made almost 3.5%.
Right.
So it shows it's another layer of diversification. Diversify your currency exposure as well. Your geography, your currency, your market cap, all of that makes sense long term.
Yeah. And it goes back to, again, that awareness conversation. And we always encourage everyone to be reviewing your asset allocation on a regular basis. And we know that many times there's a lot of different accounts out there that you have, whether it's your personal investment accounts, your retirement accounts, or even your significant other or spouse's accounts. You want to understand how that is all merging together, especially addressing some of the stock exposure and some of the performance that Mike has highlighted out there over the course of the last even 5 years.
Yeah.
Again, it comes back down to making sure you're aware and comfortable with that exposure, because at the end of the day, you want to maintain that diversification. You want to make sure that, especially where you're at in your time horizon of your working career, you're evolving that portfolio. Because if we do see a significant downturn, you don't want that to be a huge setback for you or a surprise because you're overexposed to a certain area of the market that may be carrying higher risks that you weren't comfortable with. So another term we like to use is rebalancing. That's something that you look at your portfolio, whether it's quarterly, semi-annually, or annually, to make sure you're maintaining the integrity of your asset allocation. We'll talk more about what the plan consists of from a financial planning standpoint here later, but that's also a major focus that we encourage everyone to be looking at least on an annual basis to make sure that that asset allocation is aligned.
And then, Michelle, we see your question, just a quick tease because we're going to fully address that later. The last time foreign stocks outperformed U.S. stocks was the first year of the first term for President Trump. So I know it seems, with everything going on right now with tariffs, it seems far-fetched, but markets can behave very oddly. So we'll talk about that a little later on. So then the next thing we want to talk about, and we're going to put this chart up on the full screen, even though it's a little scary, is when am I going to make money in bonds? And to start that discussion, we're actually going to look at the U.S. fiscal deficit and what it's projected, how it's projected to evolve over the next 10 years. And right now, we're at a point where we're running the largest fiscal deficits as a nation that we've ever had outside of a recession or a war. So it's a tough spot to be in. And there's a lot of debate over the impact of potentially extending those 2017 tax cuts, what that's going to do to the deficit trajectory. But the reality is, it's not going to make that big of a difference. We're already in a pretty tough spot. So you think about this, and there isn't a lot of agreement on how we as a country are going to solve this problem. Do we try to grow our way out of it, inflate our way out of it, raise taxes, lower taxes, go to war? We're not going to talk about any of that. But what does this mean for you as a bond investor? What does it mean for the outlook for bonds in your portfolio? Because they've been very unloved. So we'll go to the U.S. 10-year Treasury yield. The implication is if we as a country mismanage our finances and have unsustainable fiscal deficits, there should be a penalty for that. And the penalty should be we as a nation should have to borrow money at higher interest rates. When we issue debt, we shouldn't get as low of an interest rate. And that's happening. It's happening for a number of reasons, but the yield on a U.S. 10-year Treasury note is 4.8% right now. So that's right around the highest levels. And you see we've been around these levels for a while now, since 2022. That's about the highest level since 2007. So what's difficult as an investor, and when you all look at your portfolio, is back in COVID, the yield on a 10-year Treasury note was about 0.5%. So bond prices were very high. Then there was this massive reset in bond yields rising, bond prices falling. That was tough. That 2022 was it was the worst year if you were a bond investor since, I believe it was 1942, the early 40s. It was really tough, extremely damaging to those total returns, your trailing returns. If you look back at the trailing 3, 5, 10-year returns for any bond index, it's not good. But we have to isolate that and talk about the outlook and how you're going to make money in bonds going forward. That happened during the Fed's rate hike cycle. The rate hiking cycle is over, all right? Since October 2022, if you had bought and held bonds, you've made money. And then you think about going forward, how am I going to make money in bonds? The first reason people buy bonds are for the yield or the income. So over the next 10 years, if you were to buy a 10-year Treasury note today and you just hold it and bond yields don't change, you would make your yield. You'd make 4.79% annualized. That's an incredible starting point if you're thinking about how do I get to 5%? How do I get to a 7% return target to make my financial plan work? That's a great start, a great head start. Way different than back in COVID, where if you're trying to get any type of a return and you're allocating to bonds at a 0.5% yield, good luck. right? So the math is totally different now. You're much more set up for success owning bonds. The other thing that happens is, well, I said if bond yields don't move, you make 4.8%. That's not realistic. Bond yields move all the time.
Right.
But you have to think about your risk reward going forward. We're at the point now where your income or your yield is so attractive that it's a cushion against any market losses. So if bond yields rise 1% from here, which would be a big move, you're only going to lose about 3%. But if they fall 1% from here, which could definitely happen, you're going to make 13%. So your risk reward is skewed towards gains and your yield is extremely attractive. So revisiting bonds in your asset allocation as a tool to achieve your financial goals, even though the trailing returns don't look good,
Right.
is extremely important right now.
Right. So as we look at this chart, and just to reinforce, as interest rates go up, bond principal goes down, and vice versa. If interest rates go down, bond principal goes up. Now, obviously, where we're at today, when you think about investors within their retirement accounts or even their personal investment accounts, they may own a lot of mutual funds. But then we also get the conversation around, should I own individual bonds? Is that going to create a better outcome for my strategy or not? Can you dig into that a little bit?
Yeah, when we think about from a planning standpoint, owning a basket of individual bonds versus owning a fund, there are merits to either strategy. We advise on both of them. We recommend both of them based on the client's situation. Individual bonds, one, there's peace of mind. You think, I'm buying an individual bond, I'm going to hold it to maturity. I don't care what goes on in the world or what happens with bond yields between now and then. I'm just going to get my principal back when this bond matures.
Right.
And maybe there's specific bonds for your jurisdiction. Maybe they're for wherever you live. Maybe it's, it's you prefer corporates, treasuries, whatever the case may be. So there's a planning aspect there. The other thing you can do if you own individual bonds is you can time up the interest payments and you can time up the interest payments and the principal payments to work with your financial plan. So that's great too. So those are your merits of owning individual bonds. In terms of owning a fund or an ETF,
right,
you get extremely cheap access to thousands of bonds. So you get way more diversification than you could by going out and trying to build an individual bond portfolio by yourself.
Yeah.
And you can hire some of the greatest bond managers in the world to manage your portfolio. So there are merits to both strategy. It's really a personal discussion around what you need out of your financial plan.
Yeah. And this is certainly an area of discussion for clients that we talk to on a regular basis too. And the focus there is like the starting point, going back to that, looking out the front window. And certainly as you look at your even retirement time horizon, this is becoming even the most attractive environment to basically create a diversified income strategy. As you look at your retirement income needs, especially in a distribution phase, it's the best environment we've seen in the last 15 years.
Yep.
So
exactly right.
All right.
So we are going to jump forward a couple slides. Do we want to touch on this one and talk about mortgage rates?
Yeah, I think it's just a quick second because I think it's important because understanding debt, whether you have a mortgage out there, if you're looking to achieve going out and seek a mortgage at this point, there's been an interesting environment, especially since September. As we have seen the rise in interest rates, we saw a decline in interest rates for mortgages specifically, but as the Fed decided to lower interest rates, we've seen mortgage rates go up.
Yeah.
So I figured we'd just spend a moment and talk about the relationship between the two, or even how they act differently as well.
Yeah, for sure. So my wife and I want to move. We currently are fortunate enough to have a home and an extremely low mortgage rate. We know if we move to be closer to family, then we would have to give up that low mortgage rate. And so this has been a very difficult time period for the two of us because we've been watching mortgage rates and thinking, when the heck are we going to get an opportunity to move closer to family? So it's been particularly interesting since the fall because what you've had is this dynamic where the Federal Reserve is cutting short-term interest rates, but 30-year mortgage rates are going up.
Right.
And it's been extremely frustrating. So we're going to talk about, these are two different things. When the Fed cuts short-term interest rates, they're cutting things like the prime rate. They're cutting rates that are used to set rates on credit cards. but mortgage rates
which impact
react.
like money market rates, what
Exactly.
you're getting from the bank.
Exactly.
Yeah.
Mortgage rates more so take into account expectations for the Fed's future actions, not what they're doing right now. So where that comes into play, back in September, this blue line shows the market's expectations for Fed rate cuts over the next 12 months. Back in September, we got a couple bad jobs reports, and the market was thinking the Fed was going to cut 2.44%. That's why mortgage rates started to pull back. They started to come down. That ended up being sort of the low for the past year, because subsequently what happened is, one, they delivered some rate cuts. So 1% of those rate cuts actually happened. The market is still expecting about 0.4% of rate cuts in 2025. So if you do the math, you think 2.44 minus the one still in there. So now you're down to 2, minus the ones delivered, you're down to 1. Where'd the 1% of rate cuts go? They disappeared, right? And that idea of now, since September, the market's actually thinking the Fed is going to cut less than we thought. And so that change in expectations pushed mortgage rates up.
Right.
And it's for good reasons, though. The economy's doing well. The labor market actually isn't in a bad spot.
Right.
But that's been unfortunate. So the key is, how can we get this blue line to come back down? That's what my wife and I talk about. How can we get the blue line to come back down? And we're in a position now where if there's any type of noise in the labor market, or inflation just comes in cooler than expected, both of which are extremely possible, we think likely at some point during the year, we think this will go from 0.4 to something closer to -1 or even -1.5.
Yeah.
And so that should pull down mortgage rates.
Yeah.
So
yeah, and that's a topic of discussion, especially as you think about your personal relationship with debt. It's first important to understand, if you're comfortable with it. A lot of situations where folks just do not like debt. And then it comes down to what type of debt it is, and especially the interest rate that's applied to it. And we know a lot of people out there have, say, 3% mortgages. And, you may not be looking to move, but if you're comfortable with that debt and that relationship and you want to kind of maximize where your dollar goes, we're encouraging to have conversations around recasting, which is significantly different than refinancing, because refinancing is creating a whole new mortgage, and recasting is actually just re-amortizing your mortgage. So in that example, if you started off with a $500,000 mortgage at 3%, your payment in principal and interest is fixed on that. And if you've been in this mortgage for 5, 7, maybe even longer, 10 years, you've been paying that principal down. And the one idea that is worth looking at is recasting essentially re-amortizes it. Yes, that's going to spread that back out over 30 years, but it's going to drop, your principal and interest payment. And depending on where you're at in your life cycle, and again, your relationship with debt, that's something that could be worth looking at if you're looking to maximize cash flow and maybe, re-diversify where you're putting that next dollar versus continuing to put that in your real estate. So again, strategy is not for everyone. There's a lot that goes into that. Reach out to us if you have questions, but I think it's something that's not discussed enough to understand, how do you maximize, the current mortgage that you have in place today.
Yep. All right, so we're going to talk about the Trump 2.0 policy agenda now. So this is obviously happening in real time. He loves to keep it interesting. I don't know if he's put anything on Truth Social that would make what I'm about to say totally null and void in the last half hour or so. But when we think about the Trump 2.0 policy agenda, we think about 3 key pillars: tariffs, tighter immigration, and tax cuts. And what we're paid to do, what our job is to take these highly uncertain policy actions and think, what do they mean for economics, or the growth rate of the economy, inflation, the Fed, and if they're going to move interest rates, and then finally whether or not we're going to have a recession. I mean, those are the big things we're focusing on. So our view was he was going to roll out tariffs first and then focus on immigration later. Based on the last couple of days, it looks like he's doing it in opposite order or at the same time. But when we think about tariffs, the important thing to note is they're a one-time shock to the price level. So what's going to get a little scary, especially for the Fed and maybe for financial markets, is once these tariffs start getting rolled out, which we think they'll start in February and then continue into March, we're going to start to see some big month-over-month increases in the inflation prints that we're getting, whether that's CPI or core PCE. And our view is it's going to be a one-time boost to core inflation by 0.4%. We think because it's a one-time boost and everybody knows how tariffs impact inflation, the Fed, for example, is going to look through that, and it's not going to throw them off their plan for cutting interest rates, which, of course, my wife and I are very happy about. And then the next thing would be tighter immigration. When we think about that, the ramifications there are primarily on the labor market side. So we're reducing the supply of labor in future years, or at least for the next 4 years, because we're slowing immigration flows. That's going to increase the bargaining power of domestic workers so they can demand higher wages. It's also going to lower the break-even jobs rate. So, you know, the unemployment rate may go lower and lower just because there are fewer folks in the labor force. The other impact here is, if you think about the growth rate of the economy, you just take the growth rate in the labor force times the change in hours worked, and then factor in productivity, and that's economic growth. Well, if you slow the growth rate of the labor force, you're going to slow economic growth. So it should result in slower economic growth, maybe not this year, but next year and beyond.
Yeah.
And then finally, tax cuts. So everybody's waiting for tax cuts. That's what markets are excited about. Our view is they're going to use the budget reconciliation process to extend the 2027 or the 2017 tax cuts and make some additional cuts. And they should probably wrap that up before the August recess.
Right.
And they would come into effect, 1/1/2026. So that's going to have an impact on our fiscal deficit. We showed that in the earlier slide. It's going to increase earnings for companies in the S&P 500 or anywhere else. So that'll be beneficial to the equity market. And there are obviously some personal implications there.
Yeah, that's
a planning standpoint.
A lot on watch there, and the major focus that we're looking at, especially for this, obviously impacts the markets and the economy. How to do the tax cuts or the sunset that's going to affect here at the end of this year. If that goes into effect, how that is going to impact your personal tax returns. So we do focus a lot on tax planning here at CAP STRAT. And, one of the big question marks is, the standard deduction. Right now for married filing joint couples, that's up to $30,000 a year. That impacts a lot, especially as we look at deductions out there, which is also tied to the state and local income taxes. I know that was a big tax hit back in 2017, where you were capped at $10,000 on that versus being able to deduct your full real estate tax or your full state tax that you're paying. So those are things that are on watch and drive a lot of strategies, especially going into the end of this year into 2026, because we are heavily involved in our clients' donation strategies. And that itemization or that standard deduction number of 30,000 sometimes is a big hurdle to hit. And the older you get, the higher that number goes as well. So very important to monitor that, as that might evolve strategies here before the end of 2025. Also, thinking about alternative minimum tax. That's a term that maybe has not been talked about a lot, especially with the cap of the state and local income taxes at 10,000. So that's on watch to see if that comes back into play. It's basically a side-by-side calculation to make sure the government makes sure that you are paying enough taxes, which they feel is appropriate. And then finally, the estate tax from the federal level, that's approaching about $14 million per person. And that at the end of the year is scheduled to revert to about half, call it $7 million per person. And you may say I'm way above that number. It doesn't matter. But if you're here in the state of Illinois, that estate tax limit is $4 million per person. So it's important to be mindful of all these evolving changes. From the private wealth side, we'll be reporting that through our monthly videos as information evolves here. But certainly those are things that we're watching closely. But we are in agreement. A lot of this is going to get extended, but how everything's going to settle in, especially going into 2026, is what we're watching closely.
All right.
Yeah. All right. So a lot of data there, Mike. Thank you for that. And certainly a lot of question marks going forward, and we'll be watching that closely. Where we like to take this section is tie it back to things that you can control. And within these conversations and within our year-end conversation last year, it was really focused on the plan. because at the end of the day, as you think about the plan, it really drives a lot of these decisions, even around how you choose to invest your money, or give you some guidance around how to invest your money as well. So that plan really focuses on your life goals and your finances. That's going to be individual for anyone on this call here today, and it's really important to dig deep and start to prioritize what those goals are, because that will help manage your finances and create accountability to ultimately make sure you are staying on track. And the big driver of that is we talk about all this market data, that will evolve. That can change tomorrow. Yep. What will Trump do? What will he come out with? How will that move the markets? How is the economy evolving? And what that plan does is maintain a steady compass focus to make sure that you maintain your priorities and discipline around maintaining those objectives and goals itself. But the final point there, just to hit on, it does guide your investment asset allocation. And through a financial plan, it understands your capacity and your willingness even to take risk. And measuring that out of the gates helps build that confidence, but then you can layer that into your own personal risk tolerance conversation. I heard up front, someone's concerned around, their parents' affairs, and ultimately making sure that, they have enough money there. And this is what the plan does. It shows, you putting your oxygen mask on first, based on all goals and priorities, and then understanding the excess that you have out there too. Because if you have that access and you know that you might have to support your loved ones down the road, or even your parents, or even your children, those are things that the plan can help you measure and give you some real life feedback to make sure you are on track. Okay. So continuing the theme of control, just to hit on one of those last slides, making sure where you do put your next dollar, it's in line with your goal and your plan. And there's been some changes just relative to the retirement landscape that we want to focus on first. The minimum amount that you can put in is $23,500. This is for anyone that's participating within a 401k or retirement plan. But the catch-up is now at $7,500. So you combine the two of those, ultimately that equates to your total dollar amount that you personally can put into the plan itself. And now that's important because that does not include your company match. So as you finalize your financial plan, it helps identify how much you need to save. These are buckets you want to start to fill up from a tax efficient standpoint. Then finally, the IRS announced the super catch-up. Don't ask questions around the name of it itself. We're just reporting here, but this is important to make sure you are proactive. You are going out to your custodian where your plan's administered, to make sure that if you are between the age of 60 and 63, that you are taking advantage of the additional $3,750 that you can put in. And again, so that total catch-up, if you're between age 60 and 63, is $11,250. So as we think about the actions there, again, going out to your plan website to make sure that you are on track to maximize all that, if you can do so. Otherwise, reviewing that budget to see how you ultimately can get there. From an IRA standpoint, not any significant changes there. The limits are right around $7,000 a year. HSA amounts went up a little bit. If you are participating in a high deductible account, or your health plan is high deductible, then you can contribute to a health savings account as well. Where I do want to spend a moment is just thinking about 529 accounts. Something here in Illinois, if you're a new mother or parent, ultimately they are offering a seed benefit, where ultimately it's if you had a child or adopted a child after 1/1 of 2023, they'll give you $50 right into your plan itself. I know it's not significant, but hey, every dollar counts in our opinion there. Also looking at the funding limits, you can definitely exceed the $19,000 a year, which is the estate tax gifting limit. But those are things that you just want to be mindful of. Again, if you exceed those limits, you want to have special reporting behind that. And then finally, with the inherited IRAs, I do want to hit on this just because the IRS has been very lax in regards to taking required minimum distributions. This is if you inherited an account from a loved one, such as a parent, after the year of 2020. They've been lax in the sense that you have not been required to take your required minimum distributions. Here for 2025, at least as we report today, that is back online. So work with your custodian that holds those funds within the account and make sure you are administrating that appropriately, because ultimately there can be a penalty applied to that, which certainly it's not something you want to do. And I guess just to reinforce the annual gift tax exclusion amount, last year that was $18,000. That bumped up to $19,000 here for 2025. Basically, what this is the dollar amount you can give anyone with a Social Security number directly to them without having to do some additional reporting that would limit your exemption amount. So to that point, you can double that if you are married, filing joint. So where you can give $19,000, your spouse can give $19,000, you can give that to one of your children if you so choose. We discuss a lot of strategies of ultimately how to gift money to either the next generation, whether it's charities, ultimately to other loved ones. So certainly you want to be mindful of the limits, but then also going back to that plan, making sure you have the access, because ultimately you do not want to be giving money away that you may ultimately need down the road if you have a long life within retirement and you have that longevity, which I know is one of these themes here, within your life. Okay. So that wraps up at least the numbers for 2025. There's a lot of other items out there that we certainly can discuss, but these are the core ones we want to hit on today.